Now let's talk about the second method to evaluate capital budgeting decision. We can use the internal rate of return of an investment project to see whether it is a promising investment opportunity. Typically, we have an investment project with multiple cash flows. And if we want to calculate the internal rate of return, we don't have a direct solution or a direct toolkit to calculate the internal rate of return. So we guess and verify to find the implied discount rate for this investment project and calculating the internal rate of return. We can use the Excel spreadsheet to make this guess and verify. Or you can calculate the internal rate of return with your calculator. Just try different discount rates and find the discount rates that make your net present value to be zero. If we find the actual cost of capital, the discount rate is less than internal rate of return, then we accept this project. So here is an example for calculating the internal rate of return. We have this negative cash flow today and positive cash flow in year 1, year 2, and year 3. And if we calculate the net present value of this investment project with different interest rate, we can find the interest rate that made this net present value to be zero. The interest rate, we say it is the internal rate of return. And if you make these experiments, the internal rate of return will be around 17%. So now if we have the actual discount rate to be 8%, lower than the internal rate of return, then the net present value, given this 8% as discount rate, will be positive. If the discount rate is 25%, and then we calculate the net present value of this discount rate as 25%, you will find the net present value of this investment project to be negative. So then we find if the actual discount rate is lower than the internal rate of return, net present value will be positive. We accept this project. If the actual discount rate is higher than the internal rate of return, then the net present value will be negative. We reject this project. Let's consider an example in using the internal rate of return. Suppose Dell Computer has two different investment projects. The first project has cash flow in the next 3 years. After pay the upfront payment of $450,000, Dell can collect revenue in year 1, year 2, and year 3. Another investment project requires Dell to pay $450,000 in year 0 and promise to have revenue as $90,000 starting from year 1, and this $90,000 revenue will continue forever. Given the opportunity cost of capital as 12%, we want to know the net present value of these two investment projects. So for the first investment projects, we just calculate the present value of the cash flow in year 1, year 2, year 3, and year 0. And then we add them together. We can calculate the net present value given interest rate to be 12% is $150,000. And if we make experiments about this opportunity cost of capital, you can find the internal rate of return of this investment project as 33%. Now let's consider this second investment project. This investment project has a lump sum cash flow of $450,000 in year 0 and a perpetuity with $90,000 payment in the future. And we can calculate the net present value of this investment project too. And if you verify, the net present value of this project will be $300,000. If we make experiments with this interest rate, we can calculate the internal rate of return of this investment project will be 20%. So now we have problem. The net present value is higher for the second investment project, but internal rate of return is higher for the first investment project. Which one should we choose? We need to think about this problem. Sometimes we have these pitfalls of internal rate of return rule, especially if we have mutual exclusive projects. That is to say, among a basket of projects, we can only pick one project and we have to give up all other projects. And for these projects, they may have different scales of upfront investment. They may have different time horizons of cash flows. Here is an example of the project with different project scale. So for these two projects, E and F, Project E requires upfront investment as $10,000 and promise to pay you $20,000 1 year later. Given the interest rate to be 10%, the net present value will be $8,181. For Project F, it requires you to have an upfront investment as $20,000. 1 year later, it promises to pay $35,000 to you. Given the interest rate to be 10%, then we calculate the net present value as $11,889. But the problem is the internal rate of return of Project E is higher than Project F. So if we have enough money in hand, we can pick anyone we want. Then based on the internal rate of return, because the internal rate of return is higher than the opportunity cost of capital 10%, we should take both the Project E and both the Project F. And if we evaluate these investment projects based on net present value rule, because at the opportunity cost of capital 10%, both Project E and Project F have positive net present value, we should take them both. However, if we have to make a choice between these two projects, that is to say, the two projects are mutual exclusive, and we need to pick the most promising one, then we should select Project F, because Project F has the highest net present value. Let's consider another scenario. So in this scenario, we have these investment projects of different time horizon. For Project G, it has cash flows during year 0, year 1, year 2, and year 3. If we calculate the net present value of Project G, given the opportunity cost of capital at 10%, the net present value will be positive. It is $359.2. And if we experiment with this opportunity cost of capital, we can calculate the internal rate of return of Project G is 33%. Let's consider Project H. Project H has combined cash flows. It has a lump sum investment in year 0 and also has a perpetuity cash flows for the future years. If we calculate the present value of net present value of Project H, given the opportunity cost of capital as 10%, it will be $900. And if we experiment with this required return, we can calculate the internal rate of return of this project H is 20%. So if we use this internal rate of return rule, and we have unlimited amount of money at hand, then we should take both projects, because the internal rate of return of these two projects are higher than the current opportunity cost of capital 10%. If we evaluate project G and project H based on net present value rule, also we should take both of them, because the net present value of project G is positive. The net present value of project H is also positive. However, if we are in a situation that project G and project H are mutually exclusive, we have to make a choice. Then we should use net present value rule. So now we can find that given the project G and project H are mutually exclusive, we should select project H, because the net present value of project H is higher than the net present value of project G. Thanks.